about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then, Kalra of Target Investing, independent advisor Sharmila Joshi, and Savi Jain of 2.2 Capital join us on the show. Thank you all for joining me on the show. Today on Hot Money, we'll discuss ICICI Securities, Firstsource Solutions, the midcap IT space, and Dish TV. Let's start with the first one, and that is ICICI Securities. It's been a very weak, painful time for someone who invested in ICICI Securities, down over 20% from the issue price. So clearly, money is not being made on ICICI Securities. But and that time, the concern was valuation. But after this 20% correction, the big question we're asking is value fair now for ICICI Securities? Should that be bought into, or are there better opportunities left in the market in this entire space? So we'll ask again, Sharmila, your opening statement on ICICI Securities. Is the valuation fair? Would you buy?
So absolutely, as you said, that the problem with a lot of IPOs nowadays is that the price that is asked for hardly leaves anything on the table for new investors coming in, which is all very fine when markets are good and things are moving up, and then you get listing gains of 20-30%, and then you can do whatever you wish to do. But in the kind of scenario that we had the listing of ICICI Securities, we did see it suffer because of that. But now I think I completely agree with you. At that 520 band, it looked on the higher side of the band, but now I think at 408 it looks reasonable. It is the largest retail broker in this space, and the fact that the capital light model that they have, etc., can work in their favor going ahead. So I think that if you want to buy it at this level, given the fact that it is, after all, your largest broker in the retail space, I think it looks reasonable.
Okay, what about you, Savi?
Well, so if you look at traditional valuation multiples, it's trading at 25 times trailing earnings, and the earnings have grown at 40% CAGR for the last 4 years. So if you look at it purely from a quantitative basis, it looks like a great buy. But we are very skeptical about the entire broking space, because we are seeing a lot of disruption here. Okay. Some of it may not be so visible right now, but if you see what is happening in the West in the form of discount broking has totally taken over the traditional broking space, and ICICI makes tons of brokerage. If you are enrolled on the ICICI Direct website, you are paying almost as much as 55 bips for your delivery based trades. So that is something that may really go away in the future. In fact, their yields are going down. And secondly, the second business is the mutual fund distribution business, which is again, we see the share of regular plans going down significantly over the next decade maybe as compared to direct plans, because you end up paying 1% additional expense on that.
Okay, so your 1 minute is up, but I'll definitely come back to you. And Samir, your first word on ICICI Securities?
So I think if you look at it standalone, yes, it's cheaper than the IPO valuations. But if you see it as a whole, if you see brokerages, businesses and other NBFCs which are listed like a Moti Oswal or a Edelweiss, if you want to give that valuation, I think a standalone 25 times for ICICI Securities and a 30 times standalone for a Moti Oswal or a Edelweiss, I think I'll be better off with a Moti Oswal or a Edelweiss. Because out here I still see a standalone business getting a very high valuation because of a lot of uncertainty ahead. In the past 2 years, it's been really good as a business because of the straight line trending, but the point is the uncertainty of the business and the competition is so high. So that kind of valuation to be given even right now, I think it's a little tough.
Okay, so that's the view that we are getting in on ICICI Security. Sharmila says that, at this point of time, yes, but the other two guests don't believe so. Savi, you're talking about disruptions. Do you mean something like a Zerodha or something like that, or is there something specific that you have in mind?
No, I think you very correctly put out the right name. Zerodha already is one of the largest retail brokers in the country. You don't need to pay any brokerage to do trades there. There are some fixed kind of models that are available. Now, if you are really a savvy investor and if you have some knowledge about what is happening around you and what is happening in the world, why would you end up paying 1 to 1.5% extra of your total gross transaction? And there's no value addition that is being provided by ICICI Direct. 10 years back, I remember when I opened my ICICI bank account, there was a triple account where they linked the ICICI Direct account to my bank account, and it was probably one of the only online portals where I could easily trade, sitting at office while working. That was one advantage. But now you have everyone provides a login. You have Motilal Oswal giving maybe 20 bips, which is probably half of what iDirect pays. So iDirect and HDFC, they are one of the most expensive broking plans. So this is something that I don't see as sustainable. And secondly, this is a high operating leverage business. So margins have expanded 2x in the last 3 years because there are no the fixed costs are there are no variable costs. But it can hurt negatively also. So when markets go down or when market caps go down, when transactions come down, the costs remain, but the margins can go down half. So these are the kind of risks that we see. Therefore, I would still be skeptical. Maybe at cheaper valuations than this, maybe we'll look at it because it's a good franchise for sure.
Okay, good franchise. Samir, just a word on, apart from the valuations being expensive and they've come down significantly, are there any other concerns that you would have on ICICI Securities?
So, like he mentioned, whenever you open an ICICI bank account, you get an ICICI Securities account as well. Now, the only point is if I open an account, how much active I am. I'm more concerned about the number of accounts and the active accounts over there. So, I see more of the actual standalone brokerages having a higher percentage of activeness of the total accounts divided by the actual number of active investors. So over there, that's why that proportion of brokerages also come a little further per account on the other brokerages standalone. So I think that competition and the valuation right now are the two main concerns.
Okay, and Sharmila, very quickly, since you're the one that you said that you would accumulate at this point of time, what would be the key re-rating trigger that ICICI will have if someone wants to accumulate?
No, while I appreciate their concerns, I think they're little overdone at this stage, because I think that I also speak to a lot of retail investors, and the experience with these, those retail, these no brokerage kind of businesses and models has not been that great. So there has, there have been people who've gone absolutely, as you're saying, the savvy investors, they've gone for it, and then they found that service doesn't match up to just the promise of low brokerage. So in fact, some of them have turned back to traditional brokers. And there is a certain ease and sense of, as you're saying, sitting in your office and doing your trade when you have an account linked with your bank account. So I wouldn't take away from ICICI Securities, on that ground alone. And yes, there is competition in every business, but I think that just now they have that cushion. And at this price, the stock looks reasonable.
Okay, so that's the view they're getting in. We're getting a 360-degree view on why two of our guests don't believe it's the right time to accumulate, while Sharmila believes that, despite some of the concerns, she agrees with valuations are fair and she would go and accumulate ICICI Securities. The next one is a stock called Firstsource Solutions, not the largest of the IT. It's a small cap IT firm, but it's been doing rather well for itself. The stock is trading at a 10-year high, trading at a fresh 52-week high again, and has been a marked outperformer on any parameter that you take. The question we're asking is will the rally continue for Firstsource Solutions? So, Savi, you go first. Will the rally continue?
Well, I don't know if the rally will continue or not, but
do you like the business?
Yeah, we don't like the business. It's a, you call it an IT business, but end of the day, it's a low-end BPO or a BPM is what you call it. It has low double-digit margins. ROEs, it has not made more than 15% for a long time, and it's not even growing so well. So why would it's trading at I think 14 times earnings, and why would you pay 14 times when you had Wipro and Infosys available at similar multiples a few months back? So unless you see a marked improvement in the nature of the business, where the margins and the ROEs improve, there is no reason to pay these kind of multiples for a very low-end business like Firstsource Solutions.
Okay, what about you, Samir? Your view on Firstsource Solutions?
So I think the rally is depending on the Q4 numbers, because if you see the Q3 numbers, there was an adjustment of tax which led to a good amount of PAT growth. So there was around a 22 crore of deferred tax which was adjusted around a 14 crore tax to be paid. So that gave a big booster to the PAT. Otherwise, if you see the revenues, they have been flatlined since March 2016. Sky is one of the biggest clients in UK, and they are also downsizing at the Firstsource level. Forget about the Sky being outsourcing to them. So I think the modus operandi and the margins are any which way on the 12 to 13%, which have been the highest for them. So I wouldn't depend on it. But if the tax adjustment still comes on the Q4, might the rally continue?
Okay, so it's another guest who's saying that, not the right time. And what about you? Do you like Sharmila? Do you like
So just to continue from what both of them have said, I think the one reason why the stock benefited was that in this last quarter we've seen a great fancy for IT and mid-cap IT. So I think our next question precisely deals with that. So I think that I completely agree, but this is not the greatest business. I mean, it's not the smartest business. It is a sort of a BPO. You want to call it IT, but it's not exactly that. And they got that benefit from the numbers. So you saw suddenly, market felt that the valuation was low, and you saw that buying. But I think now it's done. My guess is that unless you see some real performance coming from them, I think now all the good numbers are priced in at this level. So I wouldn't expect the rally to continue.
Okay, so I think the consensus view that we're getting it on Firstsource Solution is that not the best time to start buying. So Sharmila, I'll start with you. What seems to be the big concern that Firstsource is having, despite so many years and a management change that happened? They haven't been able to do the best that they can.
Well, I think it's what Savi was saying, that what is the business at the end of the day. So if you're talking of a meaning at the end of the day it's a BPO, so what can you, unless you significantly change your line of business and you get into a better business, as in a more intelligent business where you can expect that kind of valuation and ramp up, whether it is revenues or orders. I don't think that you can actually, for me that's the problem in buying into a company.
Yes, like so I think you started with it, and I think what seems to be the concern here apart from it, or do you see any what re-rating could probably, or is there something in the future pipeline that that Firstsource that an investor in Firstsource should look at?
So they've been trying to make some acquisitions here and there, but if you look at the core business, you can divide it into three parts. 1/3 comes from the US healthcare business, 1/3 comes from financial services, and the other 1/3 comes from media and technology. Now in the US healthcare, they were getting a lot of business due to Obamacare, and now Trump is talking about a repeal of Obamacare, and they have also said that they will probably lose some part of that business there. They were doing, servicing the insurance companies and the hospitals there, and they were doing all of this customer management documentation, outsourced work. And a lot of the employees, unlike most ITs and BPO companies, are actually on site. And if you see, majority of their employees are on site. So therefore, they are not able to really make great margins like some other traditional BPOs where there is a clear cost arbitrage, because the nature of business that they are in, they have to be present on site. So second, if you look at the Sky is 30% of the revenues. The kind of client concentration they have, the top 5 clients form close to 50% of the revenues, and Sky alone forms 30%. If you lose any of these big clients, your really revenues fall off the cliff. So these are the kind of issues that are there, and unless they get into new segments which are high end where the margins are higher, I don't see any reason for re-rating from current levels. In fact, current levels itself we feel are pretty expensive.
Excellent. Samir, apart from the concerns that he's put out, do you believe there's anything else on the table for a Firstsource Solution investor to look forward to over the next few years?
It can be only the strategy change from coming out of BPO and maybe selling it out and becoming like a proper tech firm where you take software coding into systems and you try to get into that kind of lanes where midcap ITs is already running. So that can only change the valuations. Until unless that happens, I don't see anything changing.
Okay, so I think it's a consensus no that's coming in on Firstsource Solution. We just have to take a little bit of diversion because some news coming in on Binani Cement insolvency case. The parent company has now withdrawn its petition to the Supreme Court, which had sought to settle the case outside the insolvency process. Arpan Chaturvedi now joins us on the phone line with the details. Arpan, why did Binani Industries withdraw this plea?
That's right. So basically what has happened in the court is when the hearing started here in front of the judge bench headed by Justice A.K. Goyal and Justice Nariman, they posed the question to Binani Industries saying that the matter since is already being heard by NCLT. They said that why should we interfere at this stage since it's going to come up again on April 19th in front of the NCLT. So that was an indication that the court is not very inclined to entertain this petition. However, there were attempts, arguments by Binani Industries saying that the Supreme Court should allow because this is an offer that ensures that all the creditors are paid in full. After that, of course, we saw other lawyers. Ultratech also argued that there's no disqualification as per the Insolvency and Bankruptcy Code as to why they cannot make this offer. As far as the other side was concerned, Dalmia Cement said that it was an unholy alliance between the Binani Industries promoter and a failed bidder. Remember, Ultratech was the second highest bidder in the insolvency proceeding stage. So after hearing all of this, at the end, the Binani Industries Council said that they would like to withdraw their petition, and as indicated earlier, that they would now continue their arguments, pitching their case in front of the NCLT.
Okay, thanks so much, Arpan. We'll certainly keep you, I hope you keep us posted for more details as and when they come out. But we'll return to hot money. And we're speaking of Firstsource Solution, and we thought why not, the entire mid-cap IT space, which is extremely hot in the past few days. Most of the mid-cap stocks are trading at much higher valuation. So is there value still left in the mid-cap IT stocks compared to the traditional large cap? So that's what we are asking. I guess, Samir, so what's your top mid-cap pick in this space, IT pick in this space, and what's the rationale?
So I don't like mid-cap IT as such, but if I see the value, I see the value in Persistent Systems. Because what has happened because of their Q4 outlook, which they gave on the IP business, that has substantially got down the price. And now if this gets sorted out within the Q4 results, then I think there'll be a lot of upside after the results and the management convincing the investors that it's a one-time. Even if it's not a one-time and it spreads through, I think it's better to value something right now on the downfall rather than valuing it on the upscale. So I think Persistent for me is the topic.
Okay, Sharmila, what about you? Anything in the mid-cap IT space that you like?
So again, I think I actually wouldn't want to go with a single stock because I appreciate that you're trying to talk of a hot sector, but I think there are enough arguments to be made to buy IT, but I think the sector as a whole has had quite a big run up. I mean, a lot of these stocks we've recommended when they were 100, 150, stocks like a Sonata, Hexaware, etc. So I think I'll go with three names, which I think, for different reasons. Persistent, I think precisely what Samir said. I think that, once you give a warning like that, it's always good, I think that is better to declare if you see a problem coming in advance. I think that's always taken well when things begin to fall in place. So that would be one. I think Eclux looks attractive at this level. And Hexaware has run up, but I think there is a good expectation that numbers in this quarter also will deliver. So I think, on the back of that, you can continue to look at Hexaware.
Okay, so that's the view that we are getting it. Savi doesn't track it, so he doesn't have a view, but we'll throw it up open for questioning. Just a view, Savi, do you like mid-cap IT? I'm not telling you to be stock specific, or do you find any concerns in this sector?
No, in fact, I like it better than the frontline stocks because they have a lot of legacy business which will probably go away. Stocks like, say, Axelia Kale, which is focused on the entire aviation sector and they have large market share. But I'm not really comfortable with the valuations that they're trading at. The growth is absent. So, revenues have been actually flat for something like Axelia Kale and it's trading still at 22, 23 times trailing earnings. So that's why, it's far away from the kind of valuations we would like it to be. But something like Axelia Kale makes, more than 50% ROE. And now you compare it to something like a Firstsource Solution, that's why I would not even look at something like Firstsource. Something like, say, Axelia at better valuations. Not
Axelia at better valuation.
Yes.
Sharmila, Persistent, Samir spoke about it. You also spoke about Eclux and Hexaware. One or two lines on why you like these counters?
So I think Hexaware, as I said, you're expecting revenue as well as profitability to be sort of, in that 5, 6, 7% kind of range. which is much more than what you're seeing from your frontline stocks. So I think you will continue to, and I think typically what can also be said as a generalization for the mid-cap IT spaces, that a lot of the deals are now becoming, deal sizes are becoming smaller. So that is to the advantage of mid-cap IT, because for a large-cap IT, that's too small an order to look at. And I think a lot of them are now working in very niche spaces. So I think that is something that is common for both Hexaware and eClerx. eClerx is a niche business, and I think that they are sort of growing their business in a very steady and in a very good manner. Over the last, I've been tracking the stock over the last 5-6 years, and it's really delivered, over the years. So I think because it's a steady performer, because I think the other argument that goes against mid-cap IT is that earnings can sometimes be patchy, and you could have a one-off or maybe 2-3 quarters in a row where things go wrong because a certain order falls through, or something else happens. So I think from that perspective, I like eClerx. It's sort of been a steady performer. Hexaware, because its numbers are going to be continue to be good, and Persistent because they've already come out with this and a warning, and I think that going forward they will definitely do well once they're over that.
Okay, so that's the view that we're getting in on mid-cap IT. I think the view that we're getting, consensus view is that concern still remains because of the run-up and valuations. But individually, Samir likes Persistent. Sharmila has spoken about Persistent, eClerx, and Hexaware. And Savi said that if he wants to buy, he'll buy Axelia Kale, but at a lower valuation, not the valuation it is at currently. And the final stock we want to speak about is Dish TV. Was one of the biggest gainers yesterday. The merger has been done with Videocon DTH. There was an open offer. The promoters of Dish TV bought in much more shares in the company, and there was also an open offer that was there. Does this mean that a bottom is now fairly in place for Dish TV? Will the rally continue? That's what we are asking. So Sharmila, Dish TV, do you like Dish TV?
I think for both the reasons that you mentioned, I think that rally will continue, because if you're buying 26% at 74, it does sort of provide a base, and the merger is also done. So I think there were concerns on the way subscriptions etc. were going, but now that you have that merger with D2H, perhaps you can see that part, the business part of it also grow. So I think both things combined, I would think that the stock can go to an 85-90 kind of a level.
85-90. What about you, Savi? Any view on Dish TV?
So again, I will not look at valuations because this is again a business we feel is disrupted and is going to be disrupted. One is free dish, as we've seen a lot of the rural customers have migrated towards free dish. Now, how long will that continue is a difficult question. But Dish TV and Videocon, they are going to have a significant market share in the rural space. So that is one part. And the second is the entire OTT over the top. We spoke about this in our last investor update, where we are seeing lot of new OTT platforms global like Netflix and Amazon Prime becoming extremely aggressive, trying to build local content. And then all of these broadcasters, if you see something like a Z5, the billboards are all over the city where they're talking about new shows, youth-oriented shows on. Now with the internet disruption by Jio, where data is very cheap, a lot of these customers who are cost conscious might actually look at watching these shows on the platforms itself, because broadcasters are also having their own platforms. So these are the two disruptions that we see, and because of that, we are slightly negative on the sector.
Okay, and what about you, Samir, on Dish TV?
So I'm positive for the short term. Why I say, because again, as Sharmila mentioned, that 74 gives it base price, and on the anticipation of the synergies, it'll keep on driving for few quarters the benefits and the stock prices for few quarters. Post that, whether the business model is something which is going out of existence or not, that would be proven later on. But I think for a short term, I think the rally will continue.
Okay, so that's the view. Two of our guests to believe that it's the right time to start accumulating Dish TV. Savi does not like, because of two reasons that he quoted. We'll throw it up open for discussion. But Savi, 74 is the price that promoters, but that's just a price. But fundamentally, Dish TV has not been doing well. They've been reporting losses. Margins have been coming down. The revenues are stagnant. So on the fundamentals, is it stable?
So it wasn't stable pre-merger. It's somehow not stable even post, because there's a lot of debt which you take into the system. There's a lot of operational issues which come. This is a financial merger which has taken place. Once the financial gets over, the operational merger starts. Now over there, if you're able to cut costs really drastically and give that synergies as you have estimated, then this will really work out well for Dish TV and the group as well. So I would like to see that, but at a 74 or a 75, I think it takes out into the negatives and gives a scope for an upside risk rather than a downside.
So we just you spoke about the OTT and the Netflix and all coming in, but how important is it, because Dish is a pretty good force in the rural segment. Is there significant amount of penetration of these services in the rural segment that could minor disruptions could come in, but can it be a major disruption in the areas where Dish TV is strong?
Yeah, so one, I also spoke about the free dish, which is more relevant for the rural areas. And second, we already have 190 million cable households in India out of a total household base of 240 million. So there is adequate penetration of cable TV households in India anyways. The growth which was going to come was from, say, nuclearization of families where youth move out when they start working. And now, you are seeing youth relevant content on OTT platforms. And you have both local content as well as global content. On a Z5, everything is available live and free of cost. So when data becomes cheap and accessible even in the rural areas, which there is some statistic that the next 75% of the growth in data is going to come from rural areas. So in that context, it becomes relevant that even we associate OTTs with Netflix and Amazon, but that's not the truth. There is the biggest one is Hotstar, which has 75 million users, and the second biggest is Voot, which is Viacom's OTT platform. Everything is mostly available free there. So if you count all of that, someone who is just a distributor and not a content owner, we are also negative on exhibitors because they don't own the content. Now you can watch movies on Netflix. You can watch a Padmavat 3 weeks after the release on a Netflix, so or Amazon Prime. So those are the kind of risks that we are seeing for distributors. Subscriber growth anyway has been pretty tepid. ARPU growth has not been there. So overall, not very excited about this space.
Okay, so I think with that we are timed out. But the view that we are getting is the fact that Sharmila and Samir would like to accumulate Dish TV at this point of time. Savi isn't too enthusiastic about accumulating Dish TV. With that is a wrap on today's Hot Money. Sharmila, Savi and Samir, thank you so much for joining me on the show. We will now next speak to Sunil Kant Munjal to understand his rationale behind putting a joint bid with the Burman family for Fortis Healthcare. Stay tuned.